have been raging in the market. We have our two best minds, the EGROW experts, and Dr. Manoranjan Sharma and Mr. R.K. Anand. Both of them are here. And the chair of the session today is Dr. Manoranjan Sharma, and I'm going to request him to conduct the proceedings, and then at the conclusion, I will just come in to wrap up the proceedings. So Dr. Manoranjan Sharma, the mic is yours. We request you to kindly conduct the proceedings hereafter. Manoranjan, we can't hear you. Dr. Manoranjan, we can't hear you.
I think he's seen muted.
Yeah. Can we unmute Manoranjan Sharma?
I just call him.
Yeah. Vivek, can we unmute him from here? Ah. No, we can't hear you.
वो म्यूट पे है शायद ना, आवाज नहीं आ रही है। अच्छा चलो देखो वो आपका जो हेडफोन है वो प्रॉपर्ली कनेक्ट हो गया क्या? कनेक्टेड है, पावर इसकी देखो। यस या हेलो मनोरंजन जी।
We are facing a minor technical problem. We'll just fix it up.
Okay.
Okay. And we'll just fix it up. In the meantime, we have Mr. R.K. Anand, who's also part of the team which is speaking today. I do not know, Mr. Anand, should we start with you in that case?
Yeah, we can, sir.
We can?
We can.
So between you and Dr. Manoranjan, you must have sorted out what's the time distribution. I would then urge you, please go ahead. And then when Mr. Manoranjan Sharma joins in the later half, then he can start participating.
So we are two today, me and Manoranjan.
Yes.
Fine. So is it okay for me to begin now?
It will be a good idea. Why don't you start?
Fine. I think that will be saving of time, and meanwhile Manoranjan will be able to join us. Fine. Good evening, all the participants. My regards for Dr. Charan Singh, our mentor and the CEO of the EGROW Foundation. And we are part and parcel feel blessed to be associated with EGROW and complements its series of the webinars which are initiated by them for this topical matters, and that's going very well. So today in this series of banking post pandemic, now a turn has come to me to begin. So I begin with the Indian scenario of banking, in which I'll be chipping on least of the global banking scenario in between, because my focus will be, since pandemic is the country specific scenario, so I'll be focusing on Indian scenario. So in Mananjan, are you there?
Okay. Hello. Hello. Hello.
Yeah, you are.
Okay.
Okay, so I think you can begin.
Welcome to the webinar. I'm very happy to note that you have been able to successfully join, and your complete team, Mr. R.K. Anand and Mr. Arvind Mohan is here. So I'm very happy to see all three of you there. And now I hand over the mic to you to conduct the proceedings. Thank you.
Okay, thank you very much, Dr. Singh. At the outset, let me say that I have the pleasure and the privilege of interacting with Dr. Charan Singh on a variety of national and international fora for last 20-25 years. And it has always been a great pleasure and a privilege interacting with him. I am very happy to note that under his dynamic and vibrant leadership, EGROW is playing a pioneering role in policy making and policy advocating. Now, coming to this topic, COVID-19 has been a game changer in more ways than one. It has sometimes been compared to the global financial meltdown of October 2008 and even the Great Depression of 1929. But recent analysis, whether of the IMF, International Monetary Fund, or the World Bank, or the UNCTAD, or even other national and other international agencies, they clearly bring out that the severity of the crisis that we face today is humongous, has wide-ranging ramifications. Let me, for the sake of data crunching, just refer to one important data point which is quite recent, which was placed in the public domain by the World Bank on June 8, 2020, and which forecast to the global economy will shrink by something of the order of 5.2% this year. Now, to place things in a proper historical and comparative perspective, let me submit that this is the deepest recession since the World War II, and therefore this is a time perhaps like no other in history as we have known. India's animal spirits remain fragile despite the process of unlocking now on. I am reminded of the well-known maxim of res ipsa loquitur. Facts speak for themselves, and this is particularly true of the banking sector because the macroeconomy has taken a huge hit. Obviously, since the banking sector is some kind of a microcosm, is some kind of a model of the wider macroeconomy, it is bound to have a reflection in case of the banking sector. Before I come to specific issues, I would like to highlight 4 or 5 issues of considerable contextual significance which the banking sector is grappling with at the present. These relate to modest capital buffers for public sector banks, mounting NPAs, higher credit costs, weaker earnings because of interest reversals and lower fee income, and subdued growth prospects. But let me sound a note of caution here that it is sometimes taken to believe that the SCBs, as we refer to RBI second schedule 1934, that the scheduled commercial banks, what is popularly known as the banking industry, it's not something like a monolithic category. There are significant differences across public sector banks and private banks, and even within these two groups. Private banks, by and large, are better placed to withstand post-pandemic changes. Among important developments, particularly in relation to banking at the national level, let me refer to an important signaling mechanism used by the RBI, in terms of which the RBI has reduced the repo rate by 115 basis since March 2020 and reverse repo by 155 basis. Despite the use of this signaling mechanism, the banking system continues to have ample liquidity. There is low demand and increased banks' risk aversion. This has kept credit growth quite low, with a credit growth of 5.5% in August vis-a-vis 12% last year. CD ratio is stood at 72.5% in August 2020 versus 76.4% as at March 20. Now let me refer to some of the big picture, macro view if I may, and because this has caused disruptions on both ends of the spectrum, the short term and the medium to long term. In case of the short term, we have issues like difficulty in accessing branches for routine operations, default in loan payment by individual and retail customers, scaling down of non-essential banking operations, significant reductions in domestic and cross-border trade, reducing forex transactions, and inaccessibility to access data infrastructure, leading to reduced serviceability. There are also some issues in medium and long term. I'm reminded of Lord John M. Keynes, a very famous remark made way back in 1930s that in the long run we are all dead. But my submission to you here is that sometimes it is necessary to take a medium to long term view to place things in the right perspective. And if we look at things in a medium term perspective, we find that there is a rising need and preference for digital transactions. There are increased loan defaults, particularly by MSMEs and corporate customers, due to reduced revenue and margins, resulting in mounting NPAs. There is a flight to safety with preference for big banks and asset-backed instruments, for example, most particularly gold. There are rampant layoffs in the private sector banks due to decreased margins. Now, having given some idea of the big picture, let me turn to some kind of a disaggregated investigation, some kind of a granular examination, because it is generally maintained and perhaps justifiably, which applies to even greater force in the banking sector, is that devil lies in the detail. So when we do this kind of a granular examination, we find that incremental credit to micro and small units fell 7.6% in April-May compared to a 2.7% drop in the corresponding period last year. Credit to medium-sized industries fell 5.4% as against a fall of 0.9% earlier. Disbursements to large enterprises fell 0.4% compared to a steeper fall of 2.5% last year. Now, if we look at the industry-wide span, we find that incremental credit to all industries fell 1.5% between March and April this year, compared with a drop of 2.5% last year. Incremental credit to engineering firms fell 1.3%. Credit to construction firms fell 3.7% against 2.1% fall in last year. Disbursements to food processing companies fell 3.1% vis-a-vis a steeper fall of 3.4% last year. What bucks that trend here is that incremental bank credit to infrastructure companies shows a modest increase of about 0.1% between March and May this year compared to a 1.3% fall last year. One of the major drivers of income, output and employment at the national level and also for banks has been the fast paced growth, at least for last 15-20 years, in retail banking space and microcredit. But here we find that outstanding credit card loans fell 14.1% with an increase of 6.1% in the corresponding period last year. Consumer durable loans have fell sharply, housing loans have fell, and lending towards microcredit has fell very steeply by something of the order of 9%. Now, when we look at major industries, we find that outstanding loans to chemical manufacturers fell 10%, loans to tea producers fell 18%, credit to fertilizer companies fell 30%, telecom firms experienced a 4% contraction, bank credit to jute textile fell 7.5%. In case of, if we look at things from the credit point of view, both the government of India and the RBI had taken several proactive measures to revive a credit culture. But despite the government of India's stimulus packages and RBI's variety of conventional and non-conventional liquidity measures to reduce the counterparty risk or credit risk of loan transactions, thereby minimize the potential systemic risk of a banking crisis. It is widely accepted that defaults and delinquencies across the board are certain to rise. In fact, recently the RBI has put out in the public domain a very comprehensive report of the called the FSR Financial Stability Report, and it paints a very scary picture of the steep rise in NPAs which we may have. Besides the RBI's moratorium facility for all term loans, lenders have on their own also proactively restructured loans to reduce the cash flow burden in the near term. But more efforts are required because of the widespread pain and misery that we find all across in the Indian economy today. Banks should be prepared for losses and build capacity to deal with an increase in delinquencies and defaults. During the unlocking process, which is currently on, banks need to repurpose their go-to-market and customer acquisition model, keeping in mind changing consumer behavior. There has been a very significant revenue compression in Indian banks. Revenue from retail and commercial banks is falling very sharply as underlying consumption and transactions have seen some kind of an exponential dip. While central banks around the world have slashed interest rates, banks are reducing yields to generate business, significantly reducing their net interest margin or NIMs. Income from payments and other fee-based services is hit by a discernible slowdown in the macroeconomy. While assessments vary, most assessments agree that this year, this financial year ending March next year, we may have a contraction to the extent of 6 to 8%. Some people estimate even at 10%. So this should be the first yearly contraction in the last 41 years, and this will obviously have a spin-off effect on the banking sector. There have been measures like the moratorium, but these have reduced banks' cash flow, likely drop of up to 10% in banks' payment revenues. Now, what can banks do in this kind of a macroeconomic scenario? They cannot do much to stem the overall drop in revenue, but they need to focus on making payments safer by increasing limits on contactless payment channels and educating customers on digital wallets and other banks are required to engage with RBI to contribute towards required policy changes, optimize network, optimize number of branches, ATMs in operation, redeploy staff based on government's mandate and footfall. maintain liquidity, ensure optimum liquidity and credit deployment, assess vulnerabilities. This is going to be increasingly important, and banks need to identify strategic risks based on exposure to each sector, geography before providing loans. Now, coming to the concluding part, my take is that COVID-19 will have an enduring impact across industries, including the banking sector. Banks need to be adequately secured with their assets, qualitatively strong and amply capitalized. Post-crisis, digital maturity and COVID-19 resilience will determine a strategy of banking players. Here, what we see is three kinds of distinct trends emerging. Banks that are already future ready, ready with truly capabilities and cost elasticity, they are likely to gain greater banking space. But the flip side is that there could be greater frauds, misappropriations through the digital channels, and hence in these kind of banks there has to be a greater thrust on know your customer, KYC mechanisms, anti-money laundering, and the like. Banks that are digital laggards need to evolve and renew due to subpar COVID-19 resilience. Banks will third category of banks are those which will struggle to survive because of being digital laggards with subpar financial and operational resilience. Concerted efforts are required to reduce the stock of outstanding NPAs, which are likely to spike in the days ahead. But banks have displayed dynamism and resilience at various points in post-independent India. And I do feel that these are difficult times. The tunnel may be long and difficult, but then we shall overcome. हम होंगे कामयाब. This too shall pass. I am reminded of a very famous line of Hindi poet Randhari Singh Dinkar, wherein he says, ये नखत अमा के बुझते हैं, सारा आकाश तुम्हारा है. Those of you may not be fully familiar with the Hindi language, let me give some kind of a brief English translation. Is the stars of the sky are fading, the entire sky is yours. So this is the kind of humongous opportunity the banks have today. They are required to refashion, customize, tweak their business model. These are difficult times, but banks have displayed dynamism and resilience in the past, and I'm sure they will emerge much stronger in the days ahead. Thank you.
I think I must thank Dr. Manoranjan. But would you like to invite your co-panelist, Dr. Manoranjan?
Yeah, I request Mr. Anand to make his presentation.
The limited time available, I'll go straightway discussing the topic rather than making a formal presentation. Now, after having a detailed account of the impact done by pandemic and its future projections by Dr. Manoranjan Sharma, I enter into an area of taking the things from here way forward for the banking, looking at the timelines of FY 21, 22, and 23. So, the diagnosis of the matter comes from the word VUCA, that is volatility, uncertainty, complexity, and ambiguity. I take A as more relevant for this event, ambiguous event, and I place this event into the black swan category of risk management for the banks. In this, none of us have the experience of the clear impact which this will have and how long this will have, because this was really started as a health event, turning into economic event, and now turning into financial event. So the finance at the last leg of this, now looking at, I see banking also got impacted as the general impact of COVID is seen is basically the disruption of supply chain, nothing else. So it has just disrupted, stopped, put lockdown on the running supply chain in the economy. And our supply chain in the banking is when we are not able to recycle our funds, we have lent the depositor funds to the loan customers, and now the loan customers are under lockdown. So they are not able to bring back cash flow, and we are disrupted in this supply chain. So the challenge is how to restart this recycling of the funds so that we are back on our normal banking. So the cash flow rotation, recovery, resolution of this stuck up process of the cash flow is to be taken on hand by the bankers. We have to do it in a slightly different way, considering the deep impact of this on the economy, and particularly the factor of production. If we see the labor part of this, the human part of the factor of production has been hit very hard. So if we are able to bring this cash flow back, it's okay. Otherwise, the consequences we face, fresh round of slippages, as Manoranjan was pointing out, towards the apprehension of rising NPAs. So choice is to resolve or face additional slippages. Now, slippage is one thing which a practical banker will really fight to avoid, because it will otherwise cause us about 2x increase again in the credit cost, that is the provisioning, fall in income, de-recognition of income has to happen. So our existing income in hand will also get lost. Net loss scenario we have to face. And the muted credit growth will continue with us, since all this will stop us from lending into the fresh. Now, taking two segments, the public sector bank component of the banking is going to be impacted deep, since the large infrastructure projects and the long-term loans are on the balance sheets of public sector banks. So private sector banks are seen less impacted, and public sector banks have to really take this as a serious challenge. Government of India, RBI, as Manoranjan ji has already done, so I will just pass on that they have done very well in time. Now, coming to the path of this resolution of the problem, and with reopening of the economy, how do we reopen with the almost, say, somewhere zero cash flows with the major corporates, or if we take the best scenario, 70% loss of the cash flow and existing 20 to 30% cash flow in their hands. So cash flow is the main thing which keeps the loan of the banks performing and the industry going. So now we have to take into consideration the latest. Hello. Yes, sir. Anything? It's okay. Fine. So this we have to take on hand the implementation of the report of expert committee of the on the restructuring of the this COVID impacted loans. Now, having an ready analysis in our hand of around, say, 57 lakh crore rupees credit divided into 4 quadrants in depending upon the severity of the impact, we have now 3 classes: most severely impacted, mildly impacted, and least impacted. So I think this most severely impacted has to undergo deep restructuring, and our estimate is, as is coming from the various sources of the media also, that the amount of this may form around 7 to 8% of total bank credit. And the rough estimate of this may run into 8,50,000 crores of credit to be put back on the rails of the restructuring. So we have to go as per the degree of severity, number one. Number two, in this resolution this time, since we had soiled our hands, latest in 2012 in India, 2010 also, when this global meltdown happened in the US, we in India held hand holding of the manufacturers and MSME in India. Thereafter, we went into deep restructuring of the loans from 2012 to 2014. So now this time, I think we have got a structured framework in our hand. One, this sets away the apprehension of the banker that if I do this restructuring or refacement, I may be caught. So now we have a black and white printout in our hand in which they have suggested 5 financial ratios, 2 pertaining to the solvency and leveraging of debt, and 3 ratios of the finance pertaining to the cash flows. So this time we have to remember in banking, and all the bankers have to take it seriously, that really the statement we read in discounted cash flows, that time is money. So beware of time and cost overrun. We have to fastly convene the meetings, form the intercredit agreements, creditors agreement, which IBA has taken lead and given a formal setup to us. Now, we do this in time-bound manner and in the cost-saving manner. Otherwise, our provisioning requirement, what I see, is going to be very high. And in the event of already low profits, this additional provisioning is the threat of pulling us down into the net loss situation. Capital needs have to be addressed afresh in the light of this unforeseen, unexpected event. Looking at domestic scenario, this capital from the domestic sources is seen less. So we have to be prepared to put up the performance in the banking, in resolution of these loans, in restructuring of the loans. Case by case, we have to keep the plan ready to convince our foreign capital providers, the global funding sources, so that we are in a position to raise this supportive capital along with the growth capital. So I think a demonstration of few cases has to be done by the Indian bankers very clearly. Meanwhile, what to do till this all happens? Meanwhile, I think there is a vaccination in the form of this restructuring will go on. But for the time being, we can take product innovation on our hand. We can start product innovation in retail finance, agriculture, and MSME, so that till the time large category of loan customer get ready, we create a stream of the cash flows by these small 3 sectors, which keeps the banking going, and later on this will be the forward linkages with the large credit. By the time December, we are ready with the resolution plans. But some of the things on the concluding part which are not there in the report and which we have to do our experience from the banking is that in some large infra projects of the, this power, steel and roads, I think there will be a more deep restructuring required, which we have to bring it in our ICAs. ICA is and the intercredit agreement which the bankers sign with each other for clarity of their roles for those who are not from the banking. And certain industries may go directionally change, leaving their conventional products to the healthy, hygiene, digital products. So bankers have to be ready to change the terms and conditions of the already sanctioned loans. Additional funding for digitalization, bandwidth, and this cloud computing, etc., has to be factored in, and bankers have to develop, shore up their skill of project finance, which I take on discount that right now we are not that sharp in that. So we have to sharpen this. Change of management is likely to happen in certain plants where the management now, raises their hands that they can't take forward this restructuring. Plant is good, proposal is good, but management change is required. So that skill we have to develop. And at last, by this cash flow regeneration, deleveraging, we can kickstart the things. Certain of projects which are small and medium in nature, say by FY21, that is March, most of them will take little longer time, September 21, and then by 22, finally by March 23, I see everything getting resolved. Ceteris paribus, as in economics we say, if we remain on the timelines prescribed in the course of this resolution. So this is the way evolving on the way forward of bringing back the banking after this COVID impact. So I stop here and pass it on back to the convener for this further conduct. Thank you.
Thank you very much, Mr. Anand. Now I request Mr. Arvind Mohan to make his point.
Thank you.
Yeah. So thank you, Mr. Anand.
Welcome, sir.
And I first thanks and regards to Professor Charan Singh, our CEO, who has given me this opportunity to present my views on this. And I'll start by this, I would say, what is the thing to be there post-COVID for banks? I'm sorry, I'm not able to show my presentation. I wanted to show that. Is it visible now, the presentation? So the challenges that we have, Mr. Sharma and Mr. Anand, they have already spoken about this surge in NPAs, need for more capital. Another challenge we are facing right now is that Supreme Court decision on this moratorium. It is going to be a very, I would say, big game changer. As RBI has put it, that if the moratorium becomes interest-free, it will be about 2 trillion rupees. The banks will have to take a hit of about 2 trillion rupees, which amounts to half of their profit and 1% of the GDP of India. So there is a big thing. Supreme Court seems to be, I would say, sympathetic to the borrowers. And some way, I think, is being worked out. There is a committee formed by Ministry of Finance, and they are looking into it to somehow make it as compounding of interest should not be there. But even if the compounding of interest is not there, still it is going to mean a big amount for banks, because banks will not be able to tell their depositors that your interest will not be compounded. I hope Supreme Court and Ministry, they come out with a solution which doesn't place the banks to a big disadvantage. And another challenge post-COVID is going to be the adoption to the changed environment. There are operational challenges which are coming up. The compliance is now becoming more and more stringent. So the increased compliance cost will also be there. RBI is not very serious about that compliance. And their seriousness can be gauged from the fact that they have requested directed all the banks to have an independent chief compliance officer. So that increased cost is also going to be there. There will be a better need for better risk management. Post-Basel, those banks who could manage their risk properly, they have been more successful in their managing their balance sheets. And banks will have to be now concentrating more on this better risk management. Another aspect, NIMs are going to shrink now. we are not able to increase the loans interest on our loans, but interest on deposit also we are not able to reduce by much. So NIM is always under a strain. So minimization of cost will have to be there. I'll come back to this aspect a little later on this minimization of cost. But also there are some opportunities in this. We have to shed this feeling of gloom and doom. We have to assess our strengths. As public sector banks, we have to now assess our strengths. What are the strengths that we have? The biggest strength that we have is the confidence that the public enjoys in public sector banks, particularly the depositors. Because what has happened in case of PMC Bank, Yes Bank, does not increase the confidence of public in these private sector banks. So public sector banks, they have an advantage there, and they should use that advantage. Other thing is that the backing, to have a large reach, these public sector banks, they have to utilize that large reach. Now there is need for some new initiatives also. Whenever there is a crisis, there is a need for utilizing the existing resources in a very optimal fashion. And that brings about the initiatives. We saw this kind of initiatives happen in 1990s. And now I think again there is a time when we are facing this kind of crisis, we have to come out again with some new initiatives. Some of the initiatives that came to my mind were we should have some kind of an independent KYC agency. It's not good that a customer, if he is approaching 5 banks, has to give same KYC to 5 banks. So just like you have in case of mutual funds, we can have a centralized or say independent KYC agency which does this KYC job, and give that KYC certificate should be valid everywhere. So that will be a very, very customer friendly approach and will also reduce the burden of the banks. It will also reduce the costs. Another thing which the banks will have to do, I am coming back to what I said, that reduction of cost has to be there now, is the sharing of infrastructure. Something has started already. When we started with this doorstep banking recently, doorstep banking, private banks were already doing. What we are doing now is that we are doing something similar like collection of checks, challans, etc. from the doors of the customers. Some independent, some franchises have been engaged. But what is more important is that all the 12 banks, they joined in together and formed a separate institute for undertaking this kind of a work. IBA is already in the process of looking out for a CEO for this agency. Right now, 12 banks, they have one senior official posted in that, and they are looking into it. They are trying to coordinate these efforts. This can be extended to ATMs also. For example, we have so many ATMs of each bank. Customer is having a problem that the bank with which he is having an account, he is not able to. The ATM is not near his home. Some other bank is there, or he is somewhere where his bank's ATM is not there. So what we can do is have another agency which should manage all these ATMs. All the banks should have share in that, and in proportion of, I would say, the ATMs that they are right now having, and the proceeds, whatever can that come, they can be shared with the bank in the ratio that the shareholding is there. Something can be worked out on that. New initiatives, this sharing of infrastructure that has to be done. Some support from government is also required in this. Government has given a policy very recently that there will be identification of core sectors and non-core sectors, and in core sectors there not be more than 4 government agencies or undertakings. Banking has been identified as a core sector. Now, once we are in a core sector, that means we can have maximum 4 public sector banks. So that means apart from State Bank of India, 3 more. But already we have gone through a very painful merger process. It has not been easy. Bank of Baroda, the merger was started, I think, 2 years back. And till now, they are struggling with merging of their branches. And now the mergers which have happened from 1st of April, the merger is to the extent only that the boards that they have changed, they have 3 logos now for each bank. Nothing beyond that. If a customer of the merged bank goes to some other branch of the merged bank, he is not able to make the transaction. So it is a very, very painful process and it is going to take a long time. So at this juncture, when the banking industry is under a strain due to this COVID phenomena, I would say that government should exempt banks from that category of that we can have maximum 4 under the core sector. There is also a talk that some of the banks will be privatized. According to that policy itself, Niti Aayog has already floated that. But I feel privatization is again not a panacea. The events that happened in some of the private banks recently do not generate much of confidence in that. So that aspect also has to be taken care that it is not, if public sectors are able to perform properly, there is no need for going for privatization, just for the sake of it. Last but not the least, government needs to have a clarity of objective as to what is required. When the banks were nationalized, at that time, before that nationalization itself, there was a talk of social ownership of banks, social objectives. Then came the nationalization, banks nationalized, and nationalized banks, they were able to actually bridge that rural-urban gap. Because before that, rural areas did not have any banks, so that gap was bridged. And now, after that, came the liberalization in 1991. Before that, the objective of bank was a social motive only. But liberalization of 1991 also brought in that profit motive. And bringing in that profit motive meant that now banks have also to generate, they have also to be market facing, I would say, because their shares were to be valued according to their profit. So before that, they were only public facing. Now they also became market facing. And the events thereafter, the kind of things that have been given to banks, Jan Dhan Yojana and various government schemes, they put a strain on banks. Banks have to work for that. And naturally, they don't have that kind of profitability after all that. So I would say the government needs to be very clear as to what is required, what the government wants, whether they want it to be a social motive from banks or they want a profit motive. Both the things, that dichotomy will not serve. And the banks will not be anywhere. So the time has come, I would say, that the banks have to win back the trust of the public by returning to the basics of the banking. Why the banks are formed? Basically, banks are there to act as an intermediary between one who has money and one who needs the money. So banks actually moved away from that basics of the banking. So I think the time again has come that banks should come back to that, winning back the trust of the public by returning to the basics of the banking. And that's all I had to say. Thank you.
Thank you.
Thank you very much, Mr. Arvind Mohan. Now, in case we have any questions, any queries, we would be happy to take them.
I think others will have queries, but let me ask a question which I was just discussing for everybody joined, and that was, at the current scenario where the agriculture bills have been passed by the parliament, will it have some economic implications for the banking industry? That is one. And the second is, as Mr. Anand was mentioning, it may take 2 years to recover fully. So then the issue happens, in the interim, what should be the strategy if the panel is asked to make a recommendation to ensure that the banking industry can survive for 2 years? Specifically, I'm looking at should there be more accommodation from the Reserve Bank? Should the Basel norms have a pause? It was mentioned that the government will have to be accommodative, but I was looking at the regulatory angle also. So what would be the panel's inputs to these two questions, please?
Yes, sir. To the first question of like this additional supports from the banks or the RBI, I think within this scheme of restructuring, banks will go conventional way of dealing this situation, like the unserviceable debt is the issue, and the borrower doesn't have the cash flow to service that for some more time. So the current liabilities are more likely to be converted into long-term liabilities, refaced over a longer period of time to adjust to a serviceable debt service coverage ratio, and meanwhile, some kickstart working capital required can be considered in the same account which they already have now. So suppose they are not able to service the interest or not able to service the rotation of the funds as normally required in the cash credit. So I think some relaxation on this norm during the additional moratorium period now of say starting from 2 months to few months more can be given to them without resorting to additional pumping of the funds or coming with the fresh relaxations. The point here is to break this deadlock in the cash flow cycle. So cash flow are seen to get recycled from the small sectors, like agri is doing well, the things are reaching to MSME and will come to the large sectors by the resetting of these terms under the given scheme. So I don't think additional loans are required at the moment because it's already overburdened by the debt.
I had to add something to that.
Yeah.
The income recognition norms, as they are worldwide, so we cannot change it. But Basel norms, whatever Basel norms were there, RBI tried to be much more stringent in case of Indian banks. So I think for the moment, they can at least go back to what the international norms are for capital adequacy, so that there is a leeway for banks. And basically, what I feel is that capital adequacy should not have applied to public sector banks in the first place. Because what was the capital adequacy meant for? It was meant for ensuring that the banks do not fail. But here, sovereign is the owner. So if there is we have seen it in the past, whenever there is a problem in some bank, the government has come to the rescue. So there was no danger of banks failing, particularly public sector banks. There was no danger of failing. So in case of public sector banks, I feel this capital adequacy norms, they could have been much more diluted, and it would have increased the money in the hands of the bank, and they could have lent much more.
My take would be that the government needs to do a little bit of more hand holding, because there is a pressing need of shoring up the capital requirements of the bank. So as the major equity holder, the government has to be more proactive in this recapitalization exercise.
That's what I was saying. If the capital adequacy norms are diluted, government also will not have to put in so much of funds. After all, that is public money. And there is a general perception in public that this is taxpayers' money which is being given to banks to finance NPS.
Professor Subramaniam is saying something. I think we are not able
It's not audible.
Yeah. Just send the message to him. Meanwhile, I think we can continue. Any other question from the audience, please? Participants?
Hello.
Yeah, please.
Can I speak? I am Subramanian.
Mr. Professor Subramaniam, you're not audible. Professor Subramanian,
I think he has to unmute his mic.
you have to unmute your mic, or you could write it and I can read it for you, or other panelists can read it. You're still not audible. Maybe you should write your question and send. No, you're not audible.
Able to hear me?
Yes, now. Yes.
Yeah. A very good evening,
Good
doctor,
evening, sir. Good evening.
and good evening, all gentlemen. And these days,
Again, it's gone.
Subramanian, your voice is not audible. No, you're not audible. Can we request you to send your question in writing? Then I can read it to the panelists.
are you able to hear me now?
Yeah.
Yes.
Hello?
Yes, sir. Yes, sir.
Yeah. Very good evening. The thing is that these days we are not giving much importance to either GDP or fiscal deficit ratios or other ratios. And then looking at the balance sheet of bank, clients of banks, how far we rely on those balance sheets, and then we are going to restructure the loans, the disputed loans, sick loans, and then based on those ratios, how far they will be reliable, how we have to tackle this issue. Thank you.
In this restructuring, there is a set of documents prescribed by the expert committee. It runs about 8 to 10 reports, in which viability study is also one of the document, TEV. So that has to be done fresh. and there are certain other audits prescribed. So to allay this apprehension of what is on the black and white book and what is in reality, when we conduct the viability study now, I think this is a time to compare your book with the actuals, and wherever you find divergences, those cases are not going to succeed in the ICA.
I had to say something, sir.
Yeah.
Yes.
It has been mandated that those accounts which were already under stress before this COVID are not going to qualify for this restructuring. So it remains only for those accounts which
COVID impacted.
came under stress only due to COVID. Secondly, yes, to make the balance sheets of the banks much more, I would say, acceptable, I suggest that there should be something like that. Some provision is made on whatever restructuring is done. So RBI can prescribe that whatever accounts are restructured, there is some provisioning on that, additional provisioning. It may not be to the extent of what we have for substandard or NPA accounts, but 10% or 5% provisioning may be there because some loss is expected. So to make the balance sheet acceptable to the general public, some provisioning should be there. I agree with you.
I think I must thank Dr. Manoranjan Sharma and his two co-panelists, Mr. R.K. Anand and Mr. Arvind Mohan, for having delivered this beautiful talk and clarifying many issues that we had in their own presentations. I think that is probably the reason that we are not getting questions from the audience, because their presentations have been so well designed and they have covered most of the issues that would come in our mind. So I must thank each one of you for doing such an excellent presentation. I also want to thank the audience for connecting with us today and sparing their valuable time to participate in this presentation and webinar. We are having the next shadow monetary policy on 23rd of September, which is 2 days from today, in the evening from 5 to 6:30. In the shadow monetary policy, which will be chaired by Dr. Arvind Virmani, we will also have Professor Ashima Goel, member of the We'll have two members straight from the market participating there in the deal, and we'll also have Abhik there, and we'll have Madam Upasna, actually three of them straight from the market participating there. I would urge you to please join from 5 to 6:30 on 21st of September, on 23rd of September. And then on 25th of September, we are going to have another interesting discussion. These are the economists from Northeast, and they are going to be telling us something which is part of our country, but many of us not really thought much about it. We all know about where Gujarat is, we know where Karnataka is, but how many of us really know what is happening in our Northeast? So the two professors are going to be telling us from Northeast about COVID and the economy of Northeast. So next 2 days, I'm inviting you to please on 23rd of September and 25th of September, requesting you to please join us. The three bills that have been passed by the Parliament today, we are most probably having a discussion on Saturday, which is 26th of September, with an expert, Dr. Ashok Vishandas, who was former chairman of CACP, Professor Meenakshi from ISAC, and C.L. Dadich, Dr. C.L. Dadich, who is the secretary of the Agricultural Society and who is in Bombay. So three of them will be joining us. Timing we will let you know as the other two events happen. They will be joining us to tell us about the three bills that we have just passed in the Parliament today. With this, let me once again thank each one of you, the panelists, as well as the participants, who have spared their time to join us, and we look forward to your continued participation and benefiting from the webinar series that we have initiated in the next few days. Thank you and goodbye, everyone.
Thank you very much.
Thank you very much. Thank you.
Thank you very much, sir. Thank you. Thank you, Manoranjan ji.